For years, Salesforce was known as the company that revolutionized customer relationship management. It built one of the world's largest enterprise software businesses, serving thousands of organizations and generating tens of billions of dollars in recurring subscription revenue. But as growth slowed after the pandemic, many investors began to believe the company's best days were behind it. The market started treating Salesforce as a mature software company, profitable, stable, but no longer a major growth story. Yet over the past few years, something important has changed. Management has fundamentally reshaped the business, improved profitability, strengthened free cash flow, and begun integrating artificial intelligence across its entire platform. The question is no longer whether Salesforce is the leader in CRM. The real question is whether Wall Street is still valuing Salesforce based on its past, while the company is quietly building its next phase of growth. To answer that question, we first need to understand what the market currently believes about Salesforce, and why that perception may be incomplete. Today, the market generally views Salesforce as a mature enterprise software company. Revenue is still growing, but no longer at the double-digit rates that defined much of the last decade. As a result, investors have shifted their attention toward companies perceived to offer faster AI-driven growth. This change in sentiment is reflected in how Salesforce is discussed. The conversation has increasingly focused on slowing growth rather than expanding profitability, improving cash generation, or the company's evolving AI strategy. In other words, much of the market narrative still begins with a simple assumption. Salesforce is no longer a high-growth company. But before accepting that conclusion, we need to ask a more fundamental question. Has the business itself actually stopped evolving, or has the market simply not caught up with what Salesforce is becoming? To answer that, we need to look beyond the stock price and examine how Salesforce itself has changed over the past several years. The Salesforce that investors see today is not the same company it was 5 years ago. In the past, the investment story was straightforward: grow the CRM business, acquire complementary software companies, and expand revenue as quickly as possible. Today, the strategy is fundamentally different. Management is focused on building an integrated enterprise platform, one that combines applications, trusted customer data, automation, analytics, and increasingly, artificial intelligence. This is an important distinction. If Salesforce were still just a CRM company, then slower growth might justify a lower valuation. But if it is evolving into an enterprise AI platform with a growing ecosystem, then investors may be evaluating the company using an outdated framework. That distinction could make a meaningful difference to its long-term intrinsic value. So before analyzing the business itself, we need to define the central investment question that this research is trying to answer. Every equity research begins with a single question. For Salesforce, that question is not whether it can sell more CRM software. The company has already established itself as the global leader in that market. The more important question is whether Salesforce can leverage its installed customer base, trusted enterprise data, and expanding software ecosystem to become a central AI platform for large organizations. If the answer is yes, then Salesforce's future growth may come from increasing the value of existing customer relationships, not simply adding new customers. That would represent a different growth model, one driven by deeper platform adoption, higher customer spending, and AI-powered productivity across the enterprise. Our goal throughout this research is to determine whether the fundamentals support that thesis, and whether the current valuation fully reflects it. To answer that question, we first need to understand what Salesforce actually does, because many investors know the company by its CRM product, but far fewer understand the breadth of the platform it has built. At first glance, Salesforce appears to be a CRM software company. But that description no longer captures the full business. Today, Salesforce provides a cloud-based platform that helps organizations manage every stage of the customer lifecycle, from marketing and sales to customer service, commerce, analytics, and application development. More importantly, these products are designed to work together on a single platform, allowing customer data to flow seamlessly across different business functions. This integrated approach gives companies a unified view of their customers, enabling better decisions, greater automation, and more personalized experiences. In other words, Salesforce isn't simply selling software applications, it is building the digital infrastructure through which many enterprises manage their customer relationships. But Salesforce didn't become one of the world's largest software companies by selling a single product. To understand its strategy, we need to see why CRM was only the beginning. When Salesforce introduced cloud-based CRM, its mission was to help companies manage customer relationships more effectively. But over time, management recognized an important opportunity. Customer relationships don't exist within a single department. Marketing generates leads, sales closes deals, service supports customers, commerce processes transactions, and analytics measures performance. If these functions operate in separate systems, valuable customer information becomes fragmented. Salesforce's strategy was to connect them through one integrated platform, allowing every customer interaction to contribute to a single, shared source of truth. CRM was never intended to be the final product. It was the foundation upon which Salesforce could expand into a much broader enterprise software ecosystem. That raises an important question. Why does adding more products make Salesforce stronger instead of simply making the company larger? The answer lies in its platform strategy. Salesforce's competitive strategy is built around a simple idea: the more products a customer adopts, the more valuable the entire platform becomes. A company may begin with Sales Cloud, then add Service Cloud, Marketing Cloud, Data Cloud, or AI capabilities as its needs evolve. Because these products are designed to share the same customer data and operate within the same ecosystem, each additional product increases the value of the ones already in use. This creates a powerful economic advantage. Customers are not buying isolated software applications, they are investing in an integrated operating platform for customer engagement. Over time, this encourages deeper adoption, higher customer spending, and stronger long-term customer retention. A stronger platform is valuable, but how does that translate into financial performance? To answer that, we need to examine Salesforce's business model. Salesforce generates most of its revenue through a subscription-based software model. Instead of selling software licenses that customers purchase once, Salesforce provides continuous access to its cloud platform through recurring subscription contracts. This model creates a predictable stream of revenue, while customers receive ongoing product updates, security improvements, and new features without managing complex software installations. For Salesforce, the economics are attractive. Once the platform is deployed, the cost of serving an existing customer typically grows much more slowly than the revenue generated from that customer. The result is a business model that combines recurring revenue, expanding margins, and strong free cash flow, three characteristics investors often look for in high-quality software companies. Understanding the business model explains how Salesforce earns money. But to understand where future growth could come from, we need to examine which parts of the business generate that revenue today. Although Salesforce is widely associated with CRM, its revenue comes from a portfolio of enterprise cloud solutions rather than a single product. The company generates its largest share of revenue from Sales Cloud and Service Cloud, which remain the foundation of the business. Over time, Salesforce expanded into marketing, commerce, integration, analytics, and more recently, data cloud and AI-driven solutions. This diversification matters because it reduces dependence on any single product or growth driver. As customers adopt additional clouds, Salesforce can increase revenue within existing accounts while strengthening customer relationships across multiple business functions. In other words, Salesforce's future growth is increasingly driven by expanding its presence inside existing customers, not simply by finding new ones. But if Salesforce has so many growth opportunities, why has revenue growth slowed in recent years? To answer that, we need to separate normal business maturity from structural weakness. At first glance, slowing revenue growth might suggest that Salesforce's best years are behind it. But the reality is more nuanced. As enterprise software companies become larger, maintaining the same percentage growth becomes increasingly difficult. Growing 25% on a small revenue base is fundamentally different from growing 25% on tens of billions of dollars in annual revenue. At the same time, many large enterprises became more cautious with IT spending following the pandemic, leading to longer sales cycles and greater scrutiny of software budgets. These factors contributed to slower top-line growth across much of the enterprise software industry, not just at Salesforce. The key question, therefore, is not whether growth has slowed. It's whether Salesforce has found a new way to create shareholder value despite a slower growth environment. Management believed the answer was yes, but it required a fundamental shift in strategy. That shift became one of the most significant transformations in Salesforce's history. Recognizing that the era of growth at any cost was over, Salesforce began reshaping its priorities. Instead of maximizing revenue growth alone, management shifted its focus toward profitable growth, stronger cash generation, and higher returns for shareholders. The company streamlined operations, reduced expenses, simplified parts of the organization, and placed greater emphasis on capital allocation and operating efficiency. Importantly, this wasn't a retreat from growth. It was a transition from pursuing growth through scale to creating growth with greater financial discipline. For long-term investors, this distinction matters. A company that grows slightly slower but generates substantially more cash can ultimately create more shareholder value than one chasing revenue at any cost. This strategic shift wasn't just a change in philosophy, it quickly became visible in Salesforce's financial results, particularly in one area investors watch closely: profit margins. One of the clearest signs that Salesforce's transformation is working can be seen in its profitability. Over the past several years, the company has significantly expanded its operating margins through cost discipline, organizational simplification, and more efficient execution. While revenue growth has moderated, operating income and free cash flow have improved at a faster pace. This suggests Salesforce is becoming a more efficient business, not simply a larger one. For investors, that's an important distinction. Higher margins give management greater flexibility to invest in innovation, return capital to shareholders, or navigate economic slowdowns without compromising the business. In other words, Salesforce is no longer being defined solely by how fast it grows, but by how efficiently it converts revenue into long-term shareholder value. But improving margins is only one part of the story. The next phase of Salesforce's transformation depends on something much larger: artificial intelligence. Nearly every software company today is talking about artificial intelligence. But not every company has the same opportunity to create value from it. For Salesforce, AI is not a standalone product. It is designed to enhance the platform that customers already use every day. By embedding AI into sales, customer service, marketing, and business workflows, Salesforce aims to help employees make better decisions, automate repetitive tasks, and improve productivity using the company's existing enterprise data. This approach is strategically important because customers don't need to rebuild their software infrastructure to adopt AI. Instead, AI becomes an extension of the workflows and applications they already trust. If Salesforce executes well, AI could increase the value of every cloud product it already sells, creating growth from its existing customer base rather than relying solely on new customer acquisition. But AI alone isn't a competitive advantage. The real advantage comes from the data that powers it. And that's where Salesforce may have one of its strongest strategic assets. Artificial intelligence is only as useful as the data it can access. Public AI models are trained on vast amounts of information, but enterprise decisions require something different. They require accurate, secure, and company-specific data. That's where Salesforce has a structural advantage. For years, customers have used Salesforce to manage sales pipelines, customer interactions, service histories, marketing campaigns, and business workflows. Together, these datasets represent some of the most valuable operational information inside an organization. With platforms like Data Cloud, Salesforce is working to unify that information so AI can generate insights and take actions based on trusted enterprise data, not generic internet content. In other words, Salesforce's competitive advantage in AI may not come from building the best AI model. It comes from owning the enterprise data layer that makes AI useful in real business operations. If enterprise data is the foundation, then the next logical step is automation. That's exactly what Salesforce is trying to achieve with its newest AI strategy, Agentforce. For decades, enterprise software has largely been designed to help employees do their jobs more efficiently. Agentforce introduces a different idea. Instead of simply assisting employees, Salesforce is building AI agents that can perform specific business tasks with human oversight. These agents can respond to customer inquiries, support sales teams, resolve service requests, and execute workflows using trusted enterprise data. If this approach gains broad adoption, Salesforce's role could expand beyond being a software platform. It could become the infrastructure through which organizations deploy and manage digital workers. That is a much larger opportunity than adding another software feature. The investment thesis, therefore, is not that Agentforce will immediately transform Salesforce's financial results. It is that Agentforce has the potential to increase customer spending, strengthen switching costs, and deepen Salesforce's strategic importance over the long term. Of course, new technology alone doesn't create a durable competitive advantage. To understand whether this opportunity is sustainable, we need to examine why Salesforce customers stay with the platform in the first place. One of the strongest indicators of a high-quality software business is not how many new customers it acquires, but how difficult it is for existing customers to leave. For Salesforce, switching to another platform involves far more than replacing a single application. Over the years, customers customize workflows, integrate Salesforce with hundreds of internal systems, train employees, and embed the platform into day-to-day business operations. Replacing that ecosystem can require significant time, cost, and operational risk. In many cases, the disruption to the business is more expensive than continuing to use Salesforce. This creates meaningful switching costs. And for investors, switching costs are important because they help protect recurring revenue, support customer retention, and strengthen long-term pricing power. But switching costs are only one layer of Salesforce's competitive advantage. The ecosystem surrounding the platform may be even more difficult for competitors to replicate. Salesforce's competitive advantage extends well beyond its software. Over more than 2 decades, the company has built a broad ecosystem of customers, developers, consulting partners, independent software vendors, and third-party integrations. This ecosystem allows businesses to customize Salesforce for different industries and connect it with thousands of existing applications, reducing implementation time and increasing the platform's flexibility. As more companies build on Salesforce, the platform becomes more valuable to new customers. And as more customers adopt the platform, developers and partners have even greater incentives to invest in it. This creates a self-reinforcing ecosystem that strengthens Salesforce's competitive position and raises the barriers for competitors trying to replicate what has been built over many years. A strong ecosystem is a competitive advantage. But investors still need to ask an important question: how does Salesforce compare with the other enterprise software giants competing for the same corporate technology budgets? For Salesforce, the biggest AI opportunity isn't necessarily acquiring millions of new customers. Instead, the larger opportunity may lie within the customers it already serves. Today, many organizations use only part of the Salesforce platform. As AI capabilities become more deeply integrated across sales, service, marketing, and data management, customers may adopt additional products to unlock greater value from the platform. This creates a powerful economic model. Rather than relying solely on new customer acquisition, Salesforce can increase revenue by expanding the number of products, users, and AI-powered services purchased by existing customers. For investors, this is important because growth driven by existing customers is often more profitable, more predictable, and less expensive than growth driven entirely by winning new customers. If AI encourages customers to spend more, the next question is whether it can also improve the economics of the business itself. For a subscription software business, not all revenue growth is created equal. Winning a new customer often requires significant sales and marketing investment. But increasing spending from an existing customer is typically far more efficient. Existing customers already use the platform, their employees are trained, and their business processes are integrated into Salesforce. Expanding the relationship therefore requires much lower customer acquisition costs than starting from scratch. If AI encourages customers to adopt more products or purchase additional capabilities, Salesforce can grow revenue while improving the economics of the business. Over time, this combination of higher customer spending and operating leverage has the potential to drive faster earnings and free cash flow growth than revenue growth alone would suggest. That brings us to one of the most important questions for investors. Is this improving business model already visible in Salesforce's financial results? Before turning to valuation, it's important to evaluate the quality of Salesforce's business through several key financial metrics. Over the past 5 years, gross margins have continued to improve, highlighting the attractive economics of Salesforce's software platform. At the same time, free cash flow margins have expanded significantly, demonstrating the company's growing ability to convert revenue into cash. One metric that deserves closer attention, however, is return on invested capital. Unlike gross margin and free cash flow, ROIC has declined in recent years. This may reflect the impact of continued investment, acquisitions, or the timing of returns from those investments, but investors should monitor whether those investments generate stronger returns over the long term. Overall, Salesforce continues to exhibit the characteristics of a high-quality software business, while the trend in capital efficiency remains an important area to watch in the years ahead. Valuation is not about predicting where a stock will trade next month. It's about estimating what the business may be worth under different assumptions. In this analysis, I use 3 valuation scenarios. The conservative valuation reflects periods when market sentiment weakens or business execution falls below expectations. The historical valuation represents my estimate of fair value based on Salesforce's normalized earning power and long-term fundamentals. The optimistic valuation assumes stronger AI adoption, continued margin expansion, and a higher market multiple supported by improving business performance. No valuation model can predict the future with certainty. Instead, it provides a framework for comparing today's market price with a range of intrinsic values, helping investors make more disciplined long-term decisions. Salesforce today is a very different company from the one many investors remember. While revenue growth has naturally moderated, the business has become more profitable, more cash generative, and more disciplined in capital allocation. At the same time, artificial intelligence is expanding the value of Salesforce's platform by helping customers automate workflows and make better use of their enterprise data. The long-term investment case therefore doesn't depend on Salesforce returning to its historical growth rates. It depends on management continuing to increase the value of each customer relationship while strengthening the company's competitive position. Ultimately, whether Salesforce is a buy today depends not only on the quality of the business, but also on the price you are willing to pay. Great businesses can produce disappointing investment returns if purchased at excessive valuations, while high-quality companies bought with an adequate margin of safety can reward patient investors over the long term. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.